What up, everybody? It's Matthew Mickey here, and boy, do I have a good one for you this beginning of the month. So it's the beginning of the month, and every month you got to listen to the best iSm report you ever received, right? Because we're gonna look at it all. We're gonna dig into the details. We're gonna find the industries we should be trading in, and we're just gonna get the most out of this little small report as we possibly can. And bonus, I got a new computer, so you don't have to listen to an annoying fan in the background. You don't have to watch it freeze up. My video freezes up as I record the same, but you do still have to listen to my two English bulldogs, Biscuit and Roxy, snore their ass off while I'm trying to talk, right? And with that being said, let's get it. Now, the way we do this is we look at the global, then we look at the regionals, then we look at the actual iSm, the NSM. We pull out the industries that are showing strength. We target the ones that are showing weakness, and we start building our long-short portfolio and our cyclical portfolio off of this data, right? And so this is going to be a multi-class. The first class, we go through the iSm. We identify the industry we want to be in. Second class, we do our quantitative and qualitative to find the sector and industry outliers and are they showing growth. Third class, we'll cover volatility, liquidity within that stock that we pick, and we'll build our hedge using one of these shitty ass industries. Starting with the global PMI, as you can see, like the global PMI, starting with the United States, is still growing slow. We can see GDP year over year is 1.7. GDP quarter over quarter is negative 0.15. The key rate is 2.50. Inflation rate is still at 8.50. PMI is at 551.5 and it's growing slow. We look at China and the Eurozone, and then you can definitely check everything else out, right? China owns 16% of the world GDP. Year over year, it's up 0.4. Quarter over quarter, it's down negative 2.60. Yeah, baby. Y'all all think China's going through their growth spurt. My ass. The PMI is contracting worse than ours. Moving to Eurozone, right? Holds 13% of the GDP. And we can see that year over year, the GDP has grown 3.90. Quarter over quarter, positive 0.60. Key rate is 0.50. Inflation rate is 9.10. And PMI is contracting faster this month than it was last month, right? And moving down, let's look at India. From August to July, 56.2 from a prior 56.40. Growing is slowing down in India. Going to the right hand side of the screen, you can see the global manufacturing PMI. And as we can see at the bottom, we went from 51.1 to 50.30. However, there was a slow in the rate of change, so that's something to look out for. All right. Now we're going to look at the non-farm payroll combined with the iSm and the NSM employment rate. As you can see, we have the combined iSm employment index that I designed increasing to catch up, and we don't see non-farm payroll slowing down all that much. All right, so that tells us the labor market. That's one clue. We do a more in detailed labor market class that focuses more on production on a later video. But it shows that the labor market's not slowing down right now, just like we all heard the Fed Reserve say a billion times. And, you know, I know everybody says it's economics 101 and nobody cares about it, but I feel like the labor market needs to get crushed before we can start really truly fixing this inflation. That's just one tool that I think that needs to happen to fix the inflationary issues. That's one tool, but honestly, I think it's a crucial one along with stabilizing the debt market. That thing's volatile as no other right now. All right, moving on. We're looking at, let's look at the composite of regional PMI lead over new orders, lead over the iSm, right? Because remember, I told you guys the regional PMIs lead the new orders lead the ISM, and the ISM leads the overall S&P 500, right? And GDP. All right, so we can see the overall composite index is going down, right? The regional composite index is still going down. The iSm, the new orders of the iSm, the business activity of the NSM, and the NMI are starting to slow their trough and point upwards, right? So we're really going to have to pay attention into what leads what, right? However, you got to realize the iSm is a direct representation of, you know, a strong demand push from the cocaine of all the QEs, right? So with this being said, I trust the regional PMIs, and I feel like this month, as we can see, the market didn't care about the iSm yet, like this month. They cared about it 3 months ago, 4 months ago. Right now, everybody's focused on the labor market. All right, so moving on, let's find a play. All right, so this is the ROB, the best worst industries, right? The best being, if you look to the far right, you can see last month's numbers, month over month, 3-month average, and 6-month average, right? We can see that the best is miscellaneous manufacturers, wood products, food and beverages, and the worst industries are apparel, chemical products, and textile mills, right? However, I don't put too much weight behind the ROB because they average out, the iSm contains 5 sectors that I really care about, you know, and they average them, they give them all equal weightings. Well, based off the business cycle and what's happening in the economic cycle will determine which one's more important to you. That's why I don't put too much weight behind this. Now we're going to move on to the ones that really matter. New orders. New orders represent the amount of new orders coming into these manufacturers, right? If you look, you can see that the best that increased the most in new orders, textile mills, plastic and rubber, and computer and electronics. The worst, which had received the least amount of new customers or clients or orders, you know, would be the food industry, food, beverage, and alcohol industry, the machinery industry, and the miscellaneous manufacturing and wood products. So what the Rob said was the best, you know, the new orders, which tends to lead the iSm, says it's the worst. All right, and this is the demand portion of the iSm, the supply portion of the iSm, which would be the inventories, right? What these manufacturers have on the shelf. We can see that the best, which means like we should have a lower number for the best because that means they're taking inventory off the shelf and filling into new orders, right? If they have oversupply and then you look at the production portion of it, like in the production line isn't decreasing because they have so much inventory on the shelf, and you know they're still hiring workers in that industry, then that says that the business management plan is all jacked up, right? Because if you have enough inventories, then you shut your production line down, you focus that money onto the shipping portion of your manufacturer, and you know, like you can really see a lot of the business cycle through the iSm, right? In these different industries. So here we see the apparel, the computer, and the paper industries are the best, meaning that they're getting inventory off their shelves, which will lead to the production line having to be cranked up, which leads to the employment, which is lagging, having to increase employment, which means it will attract more orders, more customers, and it will force more money into the shipping part of that industry, right? Worst being food, machinery, and there it goes again, miscellaneous manufacturer. All right, so my long ideas from the iSm are going to be computer and electronic industry, the plastic and rubber industry, transportation equipment industry. My short ideas that I'll use to hedge my long ideas would be the wood product industry, food and beverage, miscellaneous manufacturer, and furniture and relative products, right? All right. And so what I'll do with the iSm and these ideas is now I'll go into those industries and I'll back test them to see in an inflationary environment how they perform from a volatility and a performance measurement, right? And then we'll do the quantitative phase, the qualitative phase. You know, quantitative is finding the sector and industry outliers within companies. The qualitative is digging down into that company and finding the KPIs and catalysts and volatility and where the liquidity stands and entry and targets. All right, so let's look at some of the comments that were made in these industries. Let's go to computer electronic production. This is coming directly from the survey manager from that manufacturing industry. Demand from customers is still strong, but not much of that is because there is still fear of not getting products due to supply constraints. They're just stocking up. They will be reckoning in the market when the music stops and everyone's inventory is going to get bloated, right? So basically they're saying, you know, like, it's a phenomenal effect what inflation does to you. Like, prices go up, you stockpile it because you're afraid prices are going to continue to go up, and that's what they're doing in that industry. So we're going to try to find a 20 to 60 day play in that industry to ride that tailwind, right? Plastic and rubber products orders are still strong through the end of the year, but there is a feel that customers may start pulling back on orders, either canceling them or pushing them to 2023, right? That's pretty typical for Q4 in all these industries, right? Because they had a shitty year, right? All these industries had a shitty year, so they're just going to cut 2022 for a loss and start focusing in their business plan on 2023, right? So that's them telling you without directly telling you that's what they're doing. That's a key thing to remember when we dig down into that industry and start doing quantitative and looking at EPS growth for 22 to 23 and revenue growth, right? All right, transportation equipment, strong sales continue. The impact of the chip shortage is slowing, and the decrease of COVID-19 resurgence in Asia is now affecting production more than chips. All right, cool. Moving on to the iSm and how it impacts the GDP. So one thing I've been noticing is, you know, the iSm is 80% of the economy. The iSm is 20%, right? iSm controls the companies because they build the goods and services and they ship it to the companies who sell it to the consumer, right? And in a high level of demand, like we've been seeing lately for the last 10 years, like what I've noticed is that the iSm index kind of leads GDP growth, right? Look at 2009. It troughed before anything else did. And throughout the years, you can see that, oh yeah, by the way, the iSm is the blue, the the GDP is the red, right? But you can see here, besides in 2020, you know, with quantitative easing and that huge, like, hell of a delta rate of change to promote growth, you know, besides that time, you know, the iSm manufacturing index led the peaks and troughs, right? So that's what this chart is telling me, that maybe it's peaked out, but I'm going to have to use a lot of other things to build that to get conviction from. All right, so looking overall at the iSm, you can see PMI increased this month, business increased this month, new orders increased overall this month, employment increased overall this month, deliveries dropped this month, inventories increased this month, prices decreased this month. So that means companies are selling stuff for cheaper. Orders, retaining historical orders, dropped by a lot this month. Exports increased by a lot this month. Imports increased by a lot this month, right? Now, on an industry to play in. All right, so within the iSm, like, I do focus on the business activity because that's business to consumer. As you can see, real estate's leading, but it had a decline month over month. Utilities is increasing month over month. Leading information increased month over month. Educational service led month over month in business activities. Decrease in month over month in business activities. You got retail trade, art, entertainment, recreation, a commodity and food services, agriculture, forestry, and fishing and hunting are the worst industries when it came to business activities, right? Going over to the new orders, right? Educational services, as we saw with business activity, increased month over month. Mining increased month over month. And if you look at the iSm, you'll see why. Information increased month over month. Utilities and real estate increased in new orders, right? Now that's the demand portion, right? Now let's go look at the supply portion. And remember, the higher the number, that's not a good thing when it comes to supply. That says they have a overabundance of that material, right? That they can't get off their shelves, right? All right, inventories, mining increased month over month, leading the pack with the most inventory. Food services leading, so that's definitely going to be a short because that aligns with new orders. Those are two negatives, make not a positive in this time. Utilities stayed stagnant, is no change, and then other services. All right, the best inventory shelves are agricultural, real estate, retail, trade, arts and entertainment, recreation, right? And so with that being said, we're going to be targeting the education service. We'll be targeting the information, possibly mining if I can find the good industry KPIs, right? Utilities and real estate, right? What we're going to be not targeting, but using as a short and trying to find those large cap companies to, oh yeah, when I long something, I long mid cap companies that are showing relative strength when the S&P 500 is going down. I look at a whole quantitative checklist, a whole qualitative checklist, but at the end of the day, I'm looking for a mid-cap company within this business cycle that's just the hot shot, right? When I short stuff industries, right, I'm trying to find a large cap X growth that just, plateaued on growing their goods and services, and they're just going to feel the pain to the downside, right? All right, but I'm going to be doing construction, arts, entertainment, and food services and agricultural. Agricultural may be a no-go because of the sticky inflation, but we'll see. All right, guys, next video. This is part 1 of the iSm. Next video, we take those industries, we backtest them with volatility and performance and beta and correlation, and then we find the sector outliers, doing a quantitative, looking at leading forward growth indicators, then confirming those leading forward growth indicators with the balance sheet and the financial statements and the 10-year yield. Then we go into the qualitative phase where we target the industry KPIs and we balance it out with the companies that we're looking to take a position in to make sure that they're the stellar ones within that industry so they can still market share. That's video 2. Third video, we're going to do our volatility levels, distribution of returns, find the liquidity, etc., and build the hedge position. All right, guys. Later.